Part B of the question, which reads, Cosmos Operators Limited have an optimal capital structure given as follows. There is that capital structure: ordinary share capital, reserves 16%, debt 10%, preference share capital. Additional information: number one, the firm is considering raising 20 million shillings for an expansion program, of which 2 million is expected to be raised from internal sources. Number two, new ordinary shares will be issued at 35 shillings each. A flotation cost of 5 shillings per share issued will be incurred. 3. The firm's most recent earnings per share is 3 shillings. The firm adopts 50% payout ratio as its dividend policy. Dividends are expected to grow at the rate of 5% each year in perpetuity. 4. New 10% irredeemable debentures will be issued at 110 shillings each. A flotation cost of 10 shillings per debenture will be incurred. 5. New 10% irredeemable preference shares will be issued at 40 shillings each. Corporation tax rate is 30%. Required Roman 1. Retained earnings breakpoint, 2 marks. Roman 2. The number of new ordinary shares to be issued to raise the desired external equity, 2 marks. Roman 3. The weighted marginal cost of capital in each of the intervals between the breakpoints. So that is B. Retained earnings breakpoint. Retained earnings breakpoint. That is the question. But first of all, what is the meaning of retained earnings breakpoint? Retained earnings breakpoint. Now, retained earnings breakpoint is the maximum amount of money a company can raise using its retained earnings without needing to issue new stock. You understand? Or without interfering with the capital structure. So this retained earnings breakpoint is important for various reasons. One reason is that companies aim for an optimal mix of debt and equity financing. So when a company exceeds its retained earnings breakpoint, it has to raise more equity, which can disrupt the mix or the balance between equity and debt. So that is why it's important to determine the breakpoint when investing in new projects. So that's why we are to calculate the weighted marginal cost of capital. Weighted marginal cost of capital is the weighted additional cost of capital, the additional cost of capital on projects. So one reason why the retained earnings breakpoint is important is so that the company can maintain its capital structure. Another reason is that issuing new stock often comes with additional costs like underwriting fees, like flotation costs, which can dilute the value of existing shares. And that can drive up the company's weighted average cost of capital, making it more expensive to raise money in the future. You see, in this case, the firm is considering raising 20 million for an expansion program, of which 2 million is expected to be raised from internal sources. Do you understand? I'm trying to explain the meaning of retained earnings breakpoint, and I've said it is the maximum amount of money a company can raise using its retained earnings, because retained earnings is a limited source of capital. It's not unlimited. And even if it is unlimited, a company has to maintain the mix, a balance. A company may have 50-50 capital structure, 50% debt, 50% equity. So even if a company may have enough retained earnings to finance its projects, there is that maximum amount of money that can be raised from retained earnings. And that's what is referred to as the breakpoint. Another reason, I'm giving you reasons why this breakpoint is important. Another reason is that staying below the retained earnings breakpoint, staying below, because you are saying it is the maximum. So the reason for staying below gives companies more financial stability. Why? Because they can now fund new projects or investments without relying on external sources of capital. And that helps the company to avoid dilution and higher costs. All right? So that is the meaning of retained earnings breakpoint. How is it calculated? What is the formula for retained earnings breakpoint? Now, to calculate the retained earnings breakpoint, you are going to take we read that the firm is considering raising 20 million for an expansion program, of which 2 million is expected to be raised. So this is equal to the expected amount to be raised. Expected amount to be raised, we divide by equity proportion. Equity proportion or equity ratio. Okay? That is the formula. So we have the 2 million, then we divide by the equity proportion, which we do not have. So we need to determine the equity proportion by looking at the structure, by looking at the capital structure. Do you understand? Are we moving together or moving along? Is there any question up to that point? Is there any question? The retained earnings breakpoint is calculated by dividing the expected amount to be raised, which is 2 million. We divide by the equity proportion. So we'll have a working. To calculate the equity proportion, we need a working. Going to start, and this working is working on the a working of the proportions, because we need to have the proportion. So we need to have a column for the source. So the first source here is equity. From the capital structure, equity is a source, then there is debt, is a source of capital. We have 10% preference shares. Preference shares. That's clear? We are determining the proportions. The capital structure proportions. Optimal. This is working for optimal capital structure proportions. So we just check from the capital structure. B we read, look at B. Cosmos Operators Limited have an optimal capital structure, and that structure is given. We have ordinary shares, we have reserves, we have 16% debt, then there is 10% preference shares, 10% preference shares. All right. So what is the amount for equity? Now equity is in two parts: ordinary share capital and reserves. Reserves are part of equity. So that is 80 million plus 20 million, which is equal to 100 million. It's 100 million. That is ordinary share capital and reserves. Debt, 16% debt, 40 million. Preference shares, 60 million. What will be the total? The total here is it not 200,000? Then we'll have the proportions. Proportions. So 100 million divided by 200 million, that is 0. Is it not 0.5? It's just a half. 100 is a half of that. Then 40 divided by 200. What is the proportion? Someone? Jackie. Give me the proportion for debt. Give me the proportion for debt. Jackie says 0.2. How about the other one? The proportion for preference is how much? Proportion for preference 0.2, correct? So it will be 0.2 plus 0.3. That will give us the total 0.2, 0.3. So 1.0. So these are the proportions. We are calculating the proportion so that we can apply the proportion here, 0.5, to get the retained earnings breakpoint. Retained earnings breakpoint. How much is it? $4 million. 4 million is the breakpoint. 4 million is the breakpoint. 4 million is the breakpoint. Breakpoint, 2 marks. These are 2 marks. 1, 2. 2 marks. Moving on, well, yes. Then Roman 2, the number of ordinary shares to be issued, to be raised. The number of ordinary shares to be issued to raise the desired external equity. Look at the question again. The number of new ordinary shares to be issued to raise the desired external equity. And we read in additional information, look at note number 2. New ordinary shares will be issued at 35 shillings each. A flotation cost of 5 shillings per share issued will be incurred. So you have to calculate the number of new ordinary shares to be issued to raise the desired external equity. Desired external equity. Let me do away with this. This is just a working. Do away with this working. Do away with this working so that we can calculate Roman 2. Roman 2, number of new ordinary shares. Number of new ordinary shares will be equal to the desired equity to be raised. We divide it by the issue price minus flotation cost. What is the desired equity to be raised? What is the desired amount to be raised from equity? That information should be given. New ordinary shares will be issued at 35 shillings, each flotation cost of 5. Someone give it a try. What will be the desired equity? What will be the desired equity? Desired equity, someone. Jackie says to me 10 million. Where did you get 10 million? Stays 10 million. Is it indicated somewhere 10 million? The desired amount is 10 million minus 2 million. So ask me why. I can't just answer. Maybe you understood. Is it the 2 million? No, it is not the 2 million. It is 10 million divide by, not divide, but minus 2 million. Equity. Why? Rogers, correct. 2 million is from internal source. 2 million is the retained earnings, which is part of equity. So if the total equity is 10 million, then what the company is desiring to issue, the ordinary shares to be issued from outside will be less than 2 million, because out of this 10 million, 2 million will come from internal sources. So what is to be desired is desired to be raised. The question is the number of ordinary shares to be issued. These shares will be issued to new shareholders. So we have to deduct 2 million. Then we divide by the issue price. We are told that the issue price is 35 shillings. Then you have to deduct, because you are issuing, there will be flotation costs. There will be flotation costs of 5 shillings per share. 5 shillings per share. So that will be the number of shares, of new shares, number of new ordinary shares that the company desires to raise. How much is it? Do you understand? Kevin says 266,667. You round it off. Shares cannot be in decimals. 266,667 shares, new shares, will be raised to fund this project. 2 marks. 2 marks. 1, 2. 2 marks. 2 marks. Is that okay? Yeah, Hannah got the same figure. So let's proceed and calculate the weighted marginal. The weighted marginal cost of capital in each of the intervals. In each of the intervals. The weighted marginal cost of capital in each of the intervals between the breakpoints. The weighted marginal cost of capital in each of the intervals between the breakpoints. So let's do it. Now this will take some. We're going to have tables. You do it in a table. We are going to do it in a table. The weighted marginal cost of capital in each of the intervals between the breakpoints. And we've seen that the first break will be at 4 million. All right. So let's put down the table. This is Roman 3. We have to calculate the weighted marginal cost of capital. First column will be the range of total financing. Then we'll have sources of capital. Another column is the proportion. Proportion specific cost of capital in percentage. Then lastly, you're going to have the weighted cost. Right? Range of total financing, sources of capital, the proportion, the cost, and the weight. To get the weight, we multiply the proportion by the specific cost. You understand? You need to get the table correct first. Range of total financing. So the first range is 0 to 4 million. That is the first range. 0 to 4 million. That's where we have the first break. 0 to 4 million. And here we have which sources. First of all, we are going to exhaust retained earnings. Okay? The retained earnings. Now look at the information given. The firm is considering raising 20 million for an expansion program, of which 2 million is expected to be raised from internal sources. New ordinary shares will be issued. Okay. Then we are told there that new 10% in note number 4, new 10% redeemable shares will be issued at 110 shillings each. We have the flotation cost. In note number 5, we read new 10% redeemable preference shares will be issued at 40 shillings each. So this is the information we are going to use in calculating the weighted marginal cost of capital. So we begin with the first break, the first range, 0 to 4 million. 0 to 4 million is the first break. And the source here is equity. Then we have debt. These are sources which are going to fund this project. Debt, irredeemable debentures, that is debt. Then we have preference shares. Preference shares. Okay. Equity, debt, preference shares. Equity, debt, preference shares, and the proportions we calculated here. If you are writing, we have the proportions. The equity was 0.5, 50%, 20%, 30%. So we are required to calculate the specific cost for these sources. The specific cost for these sources. So I'm going to have a working. I'm going to have here workings. 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 So equity, and candidates, this is where you need to be attentive. Equity, by now you know, comprises of ordinary share capital, reserves, retained earnings, unappropriated profits, premium. All that is part of equity. In funding this project, we saw that the firm will first of all raise money internally from retained earnings. So during the first break, the first range, we need to calculate the cost of retained earnings. What is the cost of retained earnings? We are determining the specific cost. What is the formula for calculating cost of retained earnings? This is equal to D naught, all right, into 1 plus G raised to P naught plus G. This will give us the cost of retained earnings. What is a D naught? D naught is the current DPS, the current DPS. In note number 3, we read that the firm's most recent earnings per share is 3 shillings. That is earnings per share. Next sentence reads, the firm adopts 50% payout ratio. So what is the dividend? So out of the 3 shillings, shareholders are paid 50%. Payout ratio, 50%. So 50% of 3 shillings is 1.5 shillings. That is the current. You need to just begin with the tense and the language. The most recent. This is the current DPS is 1.5. Then plus 1 plus growth rate. What is the growth rate? The growth rate, we have it. Do we have it? We have it. Yes, the growth rate is 5 shillings, 5%. Dividends are expected to grow at rate of 5% each year in perpetuity. So it will be 1.05. We divide by the market. This is the market price of this share, the MPS. Do we have the MPS? MPS. Do you have the MPS? Do you have the MPS? MPS. New ordinary shares will be issued at 35. Yes, 35. 35. Is it 35? Plus 0.05. That will give us the cost of retained earnings. How much is it? 9.5. Roger says 9.5. 9.5. So the cost of retained earnings is 9.5. 9.5%. Then cost of debt. Cost of debt, KD. How do you calculate cost of debt? Cost of debt is equal to the interest over VD 1 minus T. That is the formula for cost of debt. So what is the interest? To determine the interest, look at the note number 4. New 10% irredeemable debentures will be issued at 110 shillings each. A flotation cost of 10 shillings per debenture will be incurred. There is a flotation cost on this debenture. So what is the interest? Give me the interest. We divide by the market price of the debenture. It's very simple. To get the interest, you calculate the rate which is given at 10%. You apply it on the par value. The par value. The debenture will be issued. The par value of this debenture is 100 shillings. Just 10% of 100. Is it not so? 10% of 100 shillings. That is the interest. Interest is just 10% of 100. 10% of 100. You are told new 10%. So you take 10% and multiply by the par value that is shown in the capital structure. So 10% of 100 is equal to 10. We divide by the market value of this debenture. Note number 4. New 10% debentures will be issued at 110 shillings. That is the market price, but there is a flotation cost. So the amount there, the amount is 110, but we need to deduct the flotation cost because it is being issued. So it will be less the flotation cost times 1 minus tax. This is 0.7. Roger says 7%, 7%, 7%. So the cost of debt, 7%. Then we move to calculate the cost of preference shares. Cost of preference shares, KP. KP. What is the formula for KP? We need to calculate the preference shares. The cost of preference shares is equal to DP. DP is the debenture. I mean the dividend. DP over PO times 100. So we check from the question, what is the dividend, right? Preference dividend. Preference dividend, look at the capital structure. Preference, 10% preference share capital, 10% preference share capital, 10%, look at the capital structure, 10% preference dividend. And the par value per dividend is 30 shillings. So the dividend is 10, is it 10? Yes, 10% times 30 shillings. That is the dividend. That is the dividend per share. This is DP, dividend per share, 10% times 30. That is the par value. So in calculating the dividend, you have to apply the par value, the dividend rate times the par value. That's it. Then what is the market value of this dividend? Do we have it? Market value of the dividend. Do we have it? The market value. The par value is 30. We are not told that the dividend increased. The par value, we are not informed whether it increased. That is not number 5. The question is silent. No, it says new 10% irredeemable preference shares will be issued at 40. Will be issued at 40. That is the market. That is the market value of that preference share. So this will multiply by 100. Will give us the cost of preference. How much is it? 7.75? Yes, 7.75, correct. 7.5. That is the cost of each source. Cost of each source. Now to calculate the weighted cost, you multiply the proportion by the specific cost. So what is 0.5 times 9.5%? What is 0.2 times 7%? What is 0.3 times 7.5%? Kevin says 4.75. 4.75%. Debt, what is the cost? 1.4. 1.4%. Preference, weighted cost preference, 2.25. 2.25. Please confirm. 2.25. 2.25%. Then give me the total cost. Total cost. 4.75 plus 1.4 plus 2.25%. What is the total? Samuel says 8.4%. So this is 8.4%, and that is the WMCC at that point. WMCC. Is that clear? That is the first break. Range 0 to 4 million. Then the next range will be above 4 million. Above 4 million. Above 4 million. We need to calculate again the weighted average cost of capital at this range, beginning with equity, debt, preference. The proportions must remain 0.5, 0.2, 0.3. We know the cost of debt and cost of preference shares will not change. This will be constant, 7%, 7.5%. So the only cost that will change is equity, because above 4 million, above 4 million, we are no longer going to use retained earnings, but we will use, the company is going to issue new shares, because 4 million is the retained earnings breakpoint. Beyond 4 million, the company cannot rely on retained earnings. If you recall, we defined retained earnings breakpoint as the maximum amount of money a company can raise using retained earnings without needing to alter the capital structure. So during the first range, this is the cost. Above 4,000, the company will not use retained earnings, but it's going to use ordinary share capital. Issuing ordinary share capital, the cost of issuing ordinary share capital is not the same as the cost of issuing retained, of raising money using retained earnings. That's why the cost of equity above 4 million range is going to change. That's why we need to have a working for cost of equity. Cost of equity. This was cost of retained earnings. I want you to get the difference and get the understanding. If you've not understood this concept, please get the understanding today. There are many students who find it difficult, but it doesn't need to be difficult. Put your mind in what we are doing today. Don't postpone to understand. You know, it's very easy for you to come to this class and postpone, and you have divided attention. Just pay attention to what we are saying, and you'll get the understanding of when we say range of total financing, range between 0 to 4 million, the range about 4 million. Get an understanding that retained earnings breakpoint is the maximum amount of money that a company can raise using its retained earnings without altering its capital structure. Okay? Or without needing to raise money through issue of shares. So I'm repeating, the first range, 0 to 4 million, the company is to raise retained earnings, and the cost of equity is 9.5%. And now that the company is issuing ordinary shares, the cost of these ordinary shares will not be the same as the cost of retained earnings, because the formula is D naught into 1 plus G over P naught plus G. And there is flotation cost here. I think it is clearly indicated that flotation cost will be 5 shillings per share. So this will be equal to the D naught will be at 1.5 shillings into 1.05 over 35 minus 5 plus 0.05. So give me the cost of equity there. I know you have understood here. So what is the cost of equity? 10.25. 10.25%. 10.25%. You see, candidates, the cost of equity has gone up from 9.5 to 10.25. Why? Because cost of equity is always higher than cost of retained earnings. So give me the weighted cost, 0.5 times 10.25, 0.2 times 7%, 0.3 times 7.5%. 5.125, 5.125. Debt, weighted cost debt, Jackie, 1.4, 1.4%. Preference, 2.25, 2.25%. Total, the total is 8.775. 8.775. 8.775 is the weighted average cost, the weighted average marginal cost. So, but the question is the weighted marginal cost of capital in each of the intervals between the breakpoints in each. So the first break point, that is it. The second break point, that is it. So the range of total financing 0.0 to 4 million, the cost is 8.4%. Above 4 million, the cost is 8.775. This cost is lower because the company used retained earnings. The cost of retained earnings is always lower compared to cost of equity, which is higher, and you've seen that is why we have the difference, because you see cost of debt did not change, cost of preference shares did not change. That is 1.4, 1.4, 2.25, 2.25. So the cost has gone up because after the first break, the company had to issue ordinary share capital, and issuing ordinary share capital is expensive because of the flotation costs. And you recall we say that issuing new stocks often comes with additional costs like flotation costs, underwriting costs, and that can dilute the value of existing shares. It may also drive up the company's weighted average cost of capital. Do you have a question? We've done question 2, April 2024. Last week, we answered question 1. Is there any question? If there is no question, I would urge you to go to the past papers, identify similar questions. These questions are very common, and the examiner likes asking these questions because most students don't answer this question in the exam. It was tested last time, it may be tested again. And you can see it's very straightforward if you understand the concept. You need to understand what is retained earnings breakpoint. It is a question that has been tested many times. Even in the lower level, financial management is a common question. So ensure to practice. Attempt past paper questions. If you have any that you are not able to answer, I can help you answer the question here. But first of all, make sure you attempt questions related to breakpoints, retained earnings breakpoints. We are doing past paper questions. I'm assuming you've gone through the whole syllabus, so we're doing the most recent. The most recent, we're doing April 2024, then we are going to do December 2023, August 2023, April 2023. Bye.